Hello and Assalamualaikum everyone. Today, me and my friend want to present Mr. DIY vs Amway. I like to introduce myself and my friend. My name is MOHAMAD SYAHMI bin ISKANDAR. My metric number is 1192504. My friend's name Muhammad FAKHRUDDIN bin ZULKIFLI. Metric number 1192523. And Syed Ahmad Azri bin Syed Muhammad. Metric number is 1192524. Okay. So firstly, we go to the introduction of Mr. DIY. In July 2005, Mr. DIY opened its door as a consumer hardware store in Jalan Tuanku Abdul Rahman in Kuala Lumpur, Malaysia. At 2009, the firm opened outlet in Aeon Shopping Mall in Singapore, Tesco Setia Alam in Selangor in 2010, Giant Shopping Outlet and Borneo Hyper Mall in 2014, and Palm Square Commercial Centre in 2017. Other subsidiaries of the firm located in Selangor, Malaysia are Mr. Toy and Mr. Dollar. As of December 2020, the businesses had 734 shops in the country, including its subsidiaries. In 2017, the firm launched its e-commerce platform, Mr. DIY, provide personal protective equipment and face masks to COVID-19, hospital, government, clinics, police and the general public in Malaysia during the epidemic. Back in 2005, Mr. DIY opened his first store at Jalan Tuanku Abdul Rahman. And for the Amway, or short for American Way, is an American multi-level marketing or MLM company that sells health, beauty and home care products. The company was founded in 1959 by J. Van Andel and Richard DeVos and is based in Ada, Michigan. Amway and its sister companies under Alteco reported sales of $8.4 billion in 2019. It conducts business through a number of affiliate companies in more than 100 countries and territories. Amway has been investigated in various countries and by institutions such as Federal Trade Commission (FTC) for alleged pyramid scheme practice, but it has never been found guilty, though it has paid tens of millions of dollars to settle these suits.
Financial ratio analysis. First, profitability ratios. Gross profit margin for Mr. DIY is 42.65%, which means that every 1 ringgit of revenue and revenue is cost of amounts 0.4265 cents, while Amway has 19.52% gross profit margin and cost amounts of 0.1952 cents. So, Mr. DIY has a higher gross profit margin than Amway. That means Mr. DIY is better at controlling the cost of the stocks and the manufacturing of its product than Amway. Net profit margin for Mr. DIY is 17%. Hence, it interprets that for every 1 ringgit of revenue that Mr. DIY earns, it ends in profit 0.1317 cents, while Amway a net profit margin is 4.07%, and it lost 0.0407 for every 1 ringgit of revenue. Amway has a lower net profit than Mr. DIY. This is due to Amway has the high numbers of the revenue and make loss during operation. Instead of that, stock turnover days based on the tables, it shows that Mr. DIY takes 171.59 days to send its stock of good, while Amway takes 63.86 days. Thus, we can assume that Amway sends its inventory faster than Mr. DIY. Maybe Mr. DIY have too many branches, that is why they need to take long time to send their stock. Other than that, account receivable turnover days for Mr. DIY takes 18.22 days to collect the amounts due from its trade debtors in account receivable. Meanwhile, for Amway, takes 10.66 days. So, as conclusion, Amway's customer take 10.66 days only to pay their receivable, shorter than Mr. DIY's customer. Lastly, account payable turnover days. It indicates that Mr. DIY only takes 17.03 days to pay its creditors' income payable. Meanwhile, Amway takes 17.66 days. So the conclusion, the Mr. DIY company took shorter time to pay its trade creditor in account payable compared to the Amway.
Okay, my name is MOHAMAD FAKHRUDDIN ZULKIFLI. My metric number is 1192523. Okay, we go to the leverage ratios for in financial analysis ratio. Depend in leverage ratio parts, the term that are significantly been taken care for are debt ratio and interest cover ratio, where both of these ratio are inversely purposed. In context of benefit, debt ratio must be as low as possible, while interest cover ratio should be in high value. Debt ratio indicate the partial of company's asset that embedded by debt expense. The debt ratio for both companies, Mr. DIY Group Berhad and Amway Malaysia Holding Berhad, are quite similar, but Mr. DIY Group Berhad is more attached to debt ratio with 0.610881 compared to Amway Malaysia Holding Berhad with 0.536684. On the other hand, Mr. DIY Group Berhad leads the interest cover ratio with 1.08002 times, and the interest cover ratio for Amway Malaysia Holding Berhad is 1.05468 times. The interest cover ratio for both companies are lower than 1.5 times. And this implies a bad measurement because it shows that companies may be struggling for repay their debts. Okay, for the efficiency ratios in financial analysis ratio, in order to measure for the performance of company short terms or current performance, we use efficiency ratio, also called we call activity ratios. An efficiency ratio measure the ability of an undertaking to use asset for income generation. This measure can be contrasted to competitors from the same industry and can clarify stronger business than others. First, we calculate earning per share or EPS is an important financial measure which indicates the profitability of a company. For each shareholding, Mr. DIY Group Berhad, they has earned 5.37 cents of income, which can be dividend or keep as retained income in the company, but it will always owned by common shareholders. While for the Amway Malaysia Holding Berhad, they has earned 28.52 cents of income added as dividend to ordinary shareholder. So, Amway Malaysia Holding Berhad has the higher earning per share, which is sign of better earnings for financial position and reliable company to invest in. Okay, next, for the return on capital employed or ROCE, it is a useful measure of financial efficiency in that measure profitability after factoring the amount of capital used to create the level of profitability. The average annual return to Mr. DIY Group Berhad would be RM 0.3034 for every ringgit of financing given to Mr. DIY Group Berhad management, and the average of annual return to Amway Malaysia Holding Berhad is RM0.2745 for each ringgit. So Mr. DIY Group Berhad has higher percentage of ROCE of company's value, which can ultimately be returned as profit to stockholders. Next, return on assets or ROA is indicator of how profitable a company is relative to its total assets. The Mr. DIY Group Berhad delivered an RM0.15 ringgit return for any ringgit of asset made available to the client or in which the business best, while the Amway Malaysia Holding Berhad will generate RM0.097 return for tax on every ringgit of asset available. Return on asset percentage of Mr. DIY Group Berhad is higher than Amway Malaysia Holding Berhad. So Mr. DIY Group Berhad is better because the company is earning more money on less investment. Lastly, for the return on equity or ROE is measurement of the effectiveness of company using equity or the money that shareholder contribute to produce the revenue. From the calculation, we got Mr. DIY Group Berhad is able to generate a return of RM0.3846 after tax on each ringgit of equity put on the business or where it invests, while Amway Malaysia Holding Berhad was able for each ringgit of equity available to or in which invested to generate return after tax of the RM0.2091. A higher return on equity indicates that management team of Mr. DIY Group Berhad is more effectiveness to use investment fund to expand their company. Last but not least, for the last part of financial analysis ratio, market ratio, which include two ratio aspects, which are price earning ratio or P/E ratio and market to book ratio. In short, market ratio show a big value, then they are considered looks of financially better off. For price earning ratio, Mr. DIY Group Berhad has a huge gap and high margin with 63.85 times rather than Amway Malaysia Holding Berhad with 20.3 times. This means that Mr. DIY Group Berhad 63.85 times of its earning. In other words, investors are willing to pay 63.85 times per ringgit of their earnings. It cannot be denied because along 2020, the stock price for Mr. DIY Group Berhad increased drastically, so it showed a good result for the shareholders. Next, for the market to book ratio, the numbers compare the market price of company's share relative to historical cost of the share. It would be good if the ratio is more than 1. So from the calculation, we got Mr. DIY Group Berhad is the only one company that generate market to book ratio with 1.1588, while the market ratio to book for Amway Malaysia Holding Berhad is very low, with 0.0439. So in this case, Mr. DIY Group Berhad has generate more values for the shareholders compared to Amway Malaysia Holding Berhad.
Okay, so next we continue to SWOT. First, S for strength, W for weakness, O is opportunity, and T is threat. So, strength for Mr. DIY. First, comparison with the price of the other public peer goods. Second, leader in Malaysia home improved retail seller. And lastly, plans to grow fastly. And next for Amway, the strength of Amway is first, direct selling. Second, they have advanced technology, and lastly, they have a long-term mind in business. So, we move to other section, that is weakness. For Mr. DIY, first, goods are not durable. Second, the cashier is less friendly. Third, lack of Mr. DIY shop promotion. And for Amway, first, restrict availability mode. 2, expensive product. And third, multi-level marketing. Next, opportunities. For Mr. DIY, first, continue expansion to online business, ability to develop additional store, and third, affiliate relation to related vendor. For Amway, first, Amway can use consumer feedback to identify its flaws and turn them into strength. Second, collaboration with salons and health experts. Amway could look into collaboration with salon, beauty professional, and health experts. And third, Amway may also aim to invest in communication and investigate prospects for international advertising, such as digital marketing. And lastly is T for 3. For Mr. DIY, they can change in regulation can impact business. Second, products are rarely sold by competitor. And third, insurance costs are continually increasing. And lastly, for Amway, first is cost, as you know. Second, government restriction. And the third, or lastly, low switching costs. That means switching costs are cheap due to the quantity of identical items on the market and the introduction of e-commerce decreasing brand loyalty.
Okay, for the conclusion that we got from this presentation, both companies has a good future general condition. Even that Mr. DIY Group Berhad is a new company in this industry, the result of their financial ratio analysis is very outstanding. They are making more profit compared to their competitive in the retailer industry, and it will continue to outperform them. For Amway Malaysia Holdings Berhad, their focus sales main in Europe. It is planning why the big portion of their sales come from their export product. Amway Malaysia Holdings Berhad, so they must give more focus in the local industry since the demand is getting higher in Malaysia, which can make them more profit in this retail industry. Next, the ability to grow further and be more efficiencies in terms of generating future returns. We think for Mr. DIY Group Berhad, they need to work harder to be more efficient in generating returns. Even their profit margin is considered high, their earning per share is very low, so the investor will hesitate to invest them. We can see that Amway Malaysia Holding Berhad very efficiency in their equity management. It will increase the investor to invest to their company. However, both had a good ability to grow according to the data showed that retail sales have grown by almost 4% annually since 2010. As we emerge from the global pandemics, retail sector is growing at levels not seen in over 15 years. So, retail sales grew an estimated 6.7% in 2020. Lastly, for the suggestion, we advise to the board of directors, they must invest in Mr. DIY Group Berhad. If we look at ROE, we can know which company makes profit. If in this case, ROE for Mr. DIY Group Berhad is higher than Amway Malaysia Berhad. However, it's not a bad choice to also invest in Amway Malaysia Holding Berhad since they are also good in management. We can also make portfolio and diversify the risk of having all stock in one basket. Where more portion to be invested in Mr. DIY Group Berhad than Amway Malaysia Holding Berhad. So, we will have higher profit return. We hope board of the director can consider our suggestion and choose the right stock to invest in. It's all from us, and thank you everyone. Assalamualaikum warahmatullahi wabarakatuh.